I want to bring in now Jim Paulsen. Jim, listen, we've already seen wild gyrations today, suggesting that this market is like a coiled spring. But on the other hand, obviously, it's still vulnerable until some sort of deal is done. What are your thoughts?
Well, I think, we've really had a shock, and it's going to take a while now to stabilize, Charles, and to trend higher again at some point. But I think the worst might be over. I'm not saying we won't maybe set a marginal new low, and we certainly are going to face volatility for next few weeks, if not in a couple months. But I also think some good things have happened here with this latest collapse. We've dramatically improved valuations. The S&P PE multiple on a trailing basis now is the same place today as it was at the start of in early 2023, really near the start of the last this bull market, or right after the pandemic collapse. So early in that bull market, we've improved the concentration that was in this market with Mag 7 and tech stocks. I think the Mag 7 has lost $5 trillion in value. Their weighting's gone from like 35% down to 30% or something. That's a big improvement. We've certainly improved sentiment, Charles. We had people that said they were pessimistic even this time last week, but they weren't doing anything about it. They still had high equity positions and low cash levels. But now we've seen that change. With the panic, we're going to see people that have totally left the market. We're going to see cash levels on the sidelines go up. We saw the put-call ratio spike. We saw the VIX spike. And lastly, I just say, we've actually had quite a bit of policy support. Long-term bond yields have come down. Commodity prices have come down. The dollar's come down. All of those are stimulant forces that help ultimately to bottom this thing out. You
were on a show about a month or two ago, and the market was under a lot of pressure, and you said we hadn't seen classic capitulation. I thought you were kind of nuts, but it turns out, you were right. And then the other part of this, and I'm glad you brought it up, some of the classic contrarian buy signals, whether it comes from, the sort of the VIX and that big spike in the VIX, or we look here at some of the cyclical defensive drawdowns, obviously they're all out there. If this is any other time, many on Wall Street would be thinking, hey, this might be the time to buy the dip. Instead, we're getting a whole lot of firms saying, lowering their targets and looking for an exit.
I think that's good news. I guess my point is I see that final panic capitulation. I mean, a week ago, the talk was still, is it a good time to buy the dip? Now it is, get me the hell out, basically, is what the sentiment is. And you are seeing target prices being dropped for the year, earnings estimates being dropped, the whole gamut. I think it's good to buy in times of fear like this. This is when the risk is probably less and the upside is greater. When sentiment becomes this dour, even additional bad news might turn out to be better than what people fear.
Right.
And good news will be a real shocker, which could really bring a bid back into the marketplace.
All right, so last week, another leg that was kicked out from under the market was Jay Powell. Now, I'm not sure if the street was expecting too much, but certainly when Jay Powell, said, listen, we're going to have this, this thing, and everyone's sort of hoping he would, because he mentioned transitory in the FOMC gathering. He didn't mention it last week, but I do think this is interesting. Everyone's talking inflation. I went back, I looked at Smoot-Hawley. Inflation wasn't a problem. The market has come down a lot, but the five-year forward break-evens, they're down dramatically. This is not saying inflation. Should we be bracing for inflation, and where does this put the Fed?
I don't understand the Fed's argument worried at all about inflation right now, Charles. A tariff is a tax by any other name. And if we had just gone through a situation where President Trump raised taxes on all global output, no one would be saying that we're at risk of inflation. They'd all be saying we're at risk of recession and disinflation, maybe deflation. If I look at every financial market, bond yields, and as you said, break-evens collapsing, they're saying deflation's our problem. If you look at commodity markets today, they're all collapsing. They're saying deflation's a problem. Credit spreads are blowing out. They're saying deflation's a problem. The dollar's coming down, saying deflation is the problem. All of the financial markets are screaming for the Fed to ease, and I think they're going to have to. I think in the next few weeks, they're going to be forced to start to ease. We've only had 4 other episodes in World War II history where the market fell 10% in 2 days. That was in 1987 in the great market crash, in 2001 .com, in 2008 great financial crisis, and in the 2020 pandemic. In every one of those previous instances, the Fed eased almost instantaneously. I don't know why the Fed is waiting, but I think they're going to lose the argument. There are only a couple bad unemployment claim numbers, a further drop in commodity price numbers away from having to ease, and I think they're going to pretty soon.
Yeah, and Jim, to your point, 87, you had a brand new Fed chair, and Alan Greenspan, he came in, he saved the day, and he actually, I think, set up the blueprint for future Fed chairpersons to come in there and do what they had to do. And of course, it was always to rescue the market. Hey, Jim, I'm really glad to start the weekend, this day off with you. Thanks so much, my friend. Appreciate it.
You bet. Thanks for having me, Charles.
See you soon.